Tēnā koutou katoa, and welcome to the first of a series of deep dives on the new Presentation and Disclosure Standard, NZ IFRS 18. NZ IFRS 18 is quite a significant standard. It's really the first chance in the suite of for-profit accounting standards to reassess and reconsider how financial statements look and are used by users. So my name is Nimish Beta. I'm a technical director at the External Reporting Board, and we're joined by Carly Berry. Carly is very much the face of NZ IFRS 18. She has brought and considered how IFRS 18, the international standard, is applied and applicable in New Zealand, and she's done a lot of the thinking around the conceptual basis of these principles. So she's very well placed to take us through today's presentation. This webinar will be recorded, so you don't have to worry about scribbling down our slides. And also, these slides will be presented and made available after this recording. So please look at them and refer back to them as you go through your financial statement preparation process. NZ IFRS 18 is also a standard that requires a lot of judgment, similar to a lot of our reporting standards. So we encourage you to ask questions, think about how these would apply to your situation, and if you are available, put them into the chat today or send us an email after this webinar. We would be very happy to respond to questions and help you think about what to consider as you go about reporting under NZ IFRS 18. And lastly, in case you don't know what the External Reporting Board are or who we are, I don't know why you would be on this webinar if you didn't know what the External Reporting Board was, but just in case, we are an independent Crown entity that is responsible for developing and issuing financial reporting standards, climate-related disclosure standards, and audit and assurance standards. And the overall objective of the XRB's work is to promote trust and confidence and transparency and accountability for entities through external reporting and assurance. It's very much getting the right information to the right people at the right time. And NZ IFRS 18 very much helps us in achieving that purpose. So with that, I will pass you over to Carly, who will take us through NZ IFRS 18.
Thanks, Nimish, and no pressure being the face of NZ IFRS 18. So before we jump into the topic of this webinar, let's start off by taking a look at a few key facts about NZ IFRS 18 overall. So this standard is the New Zealand equivalent of the International Accounting Standards Board's IFRS 18 and replaces NZ IAS 1, Presentation of Financial Statements, when applied from 1st of January 2027. So early application is permitted for those who would like to early adopt. So as NZ IFRS 18 is a general presentation and disclosure standard, all for-profit entities will be impacted to some degree. Later on, we'll talk about some of the disclosure concessions for Tier 2 entities. So NZ IFRS 18 introduces 3 sets of new requirements relating to new categories and subtotals in the statement of profit or loss, enhanced requirements for the grouping of information in the financial statements, and new disclosures about management-defined performance measures. Now, as you know, the subject of this webinar is the new categories and subtotals in the statement of profit or loss. We will cover the other requirements in our next 2 deep dive webinars in August and October, respectively. Please head to the events page on our website to register for these webinars. You'll also find links to the event pages in our recent accounting alert and in our NZ IFRS 18 monthly newsletter. So let us now take a closer look at the new categories and subtotals required in the statement of profit or loss. So first of all, why did the IASB decide to bring in these new requirements? So NZ IAS 1 does not have requirements about where to classify and present income and expenses, or what subtotals to report other than profit or loss. This has led to diversity in reporting in the structure and content of the statement. Feedback from investors noted that this has made it difficult to analyze and compare financial performance specifically across entities. So in response, NZ IFRS 18 creates a new structure for the statement of profit or loss to improve comparability and understanding of the information presented in this statement. So this slide provides a snapshot of this new structure. Entities must classify income and expenses included in profit or loss into 5 categories: operating, investing, financing, income taxes, and discontinued operations. We'll talk about each of these categories in more detail shortly. NZ IFRS 18 also requires a presentation of 3 specific subtotals, 2 of them new: operating profit or loss before financing and income taxes, and the existing profit or loss total. We have created a 1-page guidance document which provides an illustration of how these categories and subtotals form a structured summary of income and expenses in the statement of profit or loss. You can find this guidance document on our dedicated NZ IFRS 18 webpage. Now, before I go on any further, some of you may be aware from reading the standard and from our other educational material, as well as attending previous XRB events, that the category labels in the statement of profit or loss are very similar to those in the statement of cash flows. It is important to note that while similar labeling is used, the content of the categories will not necessarily be aligned. And this is because the objectives of the categorization in the 2 statements are different due to users' varied information needs in relation to each of these primary financial statements. The objectives of categorization in each statement flow from the overall objective of each statement. The statement of profit or loss is prepared using the principles of accrual accounting, which provides a better basis for users to assess the entity's past and future performance, rather than information solely about cash flows during that period. However, information about cash flows helps users understand how a reporting entity has used its cash in the year, and helps users assess its liquidity or solvency and interpret other information about financial performance and how it converts into cash. So, for example, the objective of classifying cash flows in the investing activities category is to identify cash flows associated with investments made in long-term assets. This would include operating assets that will generate future returns. However, as we will soon discuss, income and expenses arising from operating assets are classified in the operating category in the statement of profit or loss, as this category includes all income and expenses arising from an entity's operations, unless NZ IFRS 18 specifically requires classification in one of the other categories. This is done in order to arrive at an operating profit or loss subtotal, which provides a consistent starting point for investors' analyses and is generally comparable between entities, even if their underlying operations are different. Entities are not required to label the categories in the statement of profit or loss, which should help to minimize any confusion between the 2 statements for users. Also, when reporting cash flows from operating activities using the indirect method in the statement of cash flows, operating profit or loss will be adjusted to arrive at net operating cash flow, as required by NZ IFRS 18, which will help explain what is resulting in these differences. We have also recently proposed a change to FRS 44, New Zealand Additional Disclosures, to ensure that if the entity uses a direct method, the required reconciliation from net operating cash flow is to operating profit or loss. Together, these 2 requirements should make it clear to users the differences between operating profit and net operating cash flow. And lastly, please note that there are situations where the IASB has deliberately aligned the classification between the 2 statements. An example of this is interest expense, which is classified in the financing category, and interest paid, which is classified as a cash flow from financing activities in accordance with amendments made to NZ IAS 7 as a consequence of the new standard. Nimish will talk about amendments to NZ IAS 7 later on in this presentation. Now, with that, let's take a look at the operating category in the statement of profit or loss. There are a few key things to note about this category. So firstly, it is effectively a default category, as all income and expenses not classified in one of the other categories will be included here. This is because all income and expenses included in profit or loss, other than those relating to investing, financing, income tax, and discontinued operations, arise from an entity's operations, which are not limited to its main business activities. Income and expenses from supporting activities still arise as the entity conducts its overall operations and should therefore be included in the operating category. For example, a retailer whose main business is to buy goods and resell these to customers may also perform research into identifying more sustainable suppliers across the world. The income and expenses from all these activities would be classified in the operating category. Also, regardless of whether income and expenses are volatile, non-recurring, or unusual in some way, they will all be included in the operating category, if not included in any other category, of course. Such income and expenses still arise from operations, regardless of whether or not they could be used to help predict future outcomes, and to exclude them would result in an incomplete picture of operating results for the reporting period. The total of income and expenses classified in this category gives us operating profit or loss, the first of the two new required subtotals that I have already briefly mentioned. In their feedback to the IASB during the development of IFRS 18, investors emphasized the importance of having such a subtotal that provides a consistent starting point for their analyses and is generally comparable between entities. So considering its importance to investors, you may wonder why the IASB decided not to define operating profit or loss directly instead of as a default category. Now, the IASB did consider doing so, but decided against this, as it would be difficult to develop a definition that is appropriate for all entities and that could be applied consistently. Overall, including income and expenses in the operating category by default, and therefore an operating profit or loss, is expected to provide the information that investors require. And lastly, we do need to think about those situations when entity provides financing to customers or invests in assets as a main business activity. Since the operating category is a default category, some income and expenses relating to these main business activities would end up classified in the investing or financing category, and thus an entity would be prevented from presenting key measures of its operating performance in the operating category. Therefore, the new standard requires entities with one or both of these main business activities to classify some income and expenses in the operating category instead of in the investing or financing category. We will go into further detail on these requirements later on in this presentation. Now, this slide shows you an example of what the operating category in the statement of profit or loss would look like. Please note that while the operating profit subtotal must be presented by all entities, the specific line items in this example would not necessarily be presented in every entity's statement of profit or loss. This is because entities are required to determine the presentation of items that will provide a useful, structured summary of income and expenses. We will go into more detail on this in the August deep dive webinar on grouping of information in the financial statements. You can also see in this example that gross profit, which is not a required subtotal, is presented. NZ IFRS 18 does not prohibit entities from presenting subtotals in addition to the required subtotals, as long as the statement structure created by the requirements in the new standard are maintained. So for example, you cannot present a subtotal that includes some items from the operating category and some items from the investing category, as this would distort the ability to present an overall view of operating profit. If an entity wishes to provide additional information about aspects of its financial performance, for example, a narrower view of the operating profit measure that excludes expenses regarded as non-recurring or unusual, it could present an additional subtotal within the operating category or disclose disaggregated information about such items in the notes. And also please remember that the category labels are not required to be presented. They're only presented here for illustrative purposes. Let's move on to the investing category. Users of financial statements often analyze returns from an entity's investments separately from its operations. The investing category allows users to identify returns from investments that are not a part of an entity's main business activities. Now, please note that the requirements that I'm about to take you through will differ if the entity invests in assets as a main business activity. We will discuss these differences later on in this presentation. The income and expenses classified into the investing category are those that arise from the following types of assets: investments in associates, joint ventures, and unconsolidated subsidiaries, cash and cash equivalents, and other assets that generate return individually and largely independently of the entity's other resources. So let's take a closer look at these assets and the reasons why the related income and expenses must be classified in this category. We start with equity accounted investments in associates, joint ventures, and unconsolidated subsidiaries. The income and expenses relating to these investments are classified in this category because of how investors analyze results from these types of investments. Specifically, investors analyze these results separately for the following reasons. The share of profit or loss is a net result after financing and income tax. To include the share of profit or loss in operating profit would distort operating profit margins, and associates and joint ventures are not controlled by the entity. It is important to note that NZ IFRS 18 does not specify the location of the line item in the investing category that presents income and expenses from these investments. Also, as I mentioned before, category labels are not required to be presented, and additional subtotals are permitted. Therefore, an entity could present an additional subtotal representing operating profit and income and expenses from equity accounted investments, if this is how they want to communicate information to their users. Now, what about those investments in associates and joint ventures that are not accounted for using the equity method? The reasons for excluding the income and expenses from investments that are equity accounted, which I've just spoken about, do not apply to those investments not accounted for using the equity method. So the IASB considered whether the classification of income and expenses arising from such investments should depend on whether the investments generate returns individually and largely independently of an entity's other resources. However, in some cases, it might be difficult for an entity to determine this, and therefore to avoid such difficulties, NZ IFRS 18 requires the income and expenses arising from these investments to be classified in the investing category. Now let's take a closer look at cash and cash equivalents, which could be seen as a reasonable proxy for excess cash and temporary investments in excess cash. The IASB noted that users of financial statements typically treat excess cash and temporary investments of excess cash as part of an entity's financing, because entities' decisions around how to manage excess cash is often related to its debt and equity financing. However, according to some stakeholder feedback, cash and cash equivalents are assets that generate returns individually and largely independently of an entity's other resources and might not be a reasonable proxy for excess cash. Also, the financing category would be simpler to understand if it only included income and expenses from liabilities. So ultimately, the new standard requires income and expenses arising from cash and cash equivalents to be classified in the investing category, as this approach makes the structure of the statement easier to understand. And finally, the income and expenses relating to other assets that generate a return individually and largely independently of an entity's other resources are classified in the investing category. Examples of such assets are investment property and debt and equity investments. In contrast, assets such as PP&E do not generate a return individually and largely independently of the entity's other resources, and so the related income and expenses for those assets are classified in the operating category. Now, we have just discussed the types of assets where the related income and expenses must be classified in the investing category, but specifically, what type of income and expenses? NZ IFRS 18 specifies that the income generated by the assets and that arise on the initial and subsequent measurement of the assets is classified in the investing category. This includes derecognition of the assets as well. For example, gains and losses from the disposal of investment property that the entity does not invest in as a main business activity would be classified in the investing category. In contrast, gains or losses on disposal of an item of PPE would be classified in the operating category. The principle here is that income and expenses from derecognition are classified in the same category as the income and expenses from the asset immediately before its derecognition. For expenses arising on the initial and subsequent measurement of the assets, including derecognition, these are classified in the investing category, similar to the income. However, NZ IFRS 18 also specifically requires incremental expenses directly attributable to the acquisition and disposal of the assets to be classified in the investing category as well. For example, transaction costs and the costs to sell the assets. Without a specific requirement to classify such expenses in the investing category, the requirements and other standards might result in inconsistent classification. For example, in some circumstances, directly attributable transaction costs are required to be included in the initial recognition of the assets and would subsequently be classified in the investing category. An example of this would be an equity investment that is measured at fair value through other comprehensive income. In other cases, Such costs are required to be recognized as an expense immediately and would therefore end up in the operating category by default. An example of this would be selling costs relating to the sale of an investment property. The specific requirement in NZ IFRS 18 means that both expenses would be recognized in the investing category. The IASB noted that identifying incremental expenses directly attributable to acquisition and disposal is not expected to be costly, because they are typically external costs identified without performing an allocation exercise. And lastly, let's take a look at the second of the two new required subtotals, profit or loss before financing and income taxes. This subtotal comprises operating profit or loss and all income and expenses in the investing category. NZ IFRS 18 requires a subtotal, as users of financial statements want to analyze an entity's performance before the effects of financing. This required subtotal serves a similar purpose to EBIT, but avoids the diverse ways in which entities distinguish between finance income and expenses and other types of income and expenses. As such, profit or loss before financing and income taxes would increase comparability between entities. Please also note that even when operating profit is equal to profit or loss before financing and income taxes, the standard still requires both subtotals to be presented, as presenting both subtotals, even when equal, could be useful, especially if information is accessed digitally. Now, this slide shows you an example of what the investing category in the statement of profit or loss looks like. As I noted a couple of slides ago, the specific line items presented will not be the same across all entities. Also, as I mentioned before, an entity could present an operating profit and income and expenses from equity account and investments subtotal, if doing so would provide a useful structured summary of its income and expenses. We now come to the financing category. Please note that the requirements that I'm about to take you through will differ if the entity provides financing to customers as a main business activity. We will talk about these differences later on in this presentation. NZ IFRS 18 distinguishes between two types of liabilities. The first type relates to those liabilities that arise from transactions that involve only the raising of finance. Examples include bank loans and bonds. Since the purpose of these transactions is to raise finance for an entity's operating and investing activities, the related income and expenses are classified in the financing category. These income and expenses are those that arise from the initial and subsequent measurement of the liabilities, including on derecognition, as well as the incremental expenses directly attributable to the issue and extinguishment of the liabilities. Some examples are included on the slide here. The requirement to classify incremental expenses directly attributable to the issue and extinguishment of these liabilities is aligned to the approach to classifying similar expenses from assets in the investing category. The second type of liability relates to transactions that do not involve only the raising of finance. Examples include payables and lease liabilities. These transactions contribute to an operating or investing activity and also provide finance to the entity. The income and expenses that are financing in nature and that relate to these liabilities are classified in the financing category. Specifically, these would be interest income and expenses, including the effects of changes in interest rates. Now, it is important to note here that these income and expenses are only classified in the financing category if the entity identifies such income and expenses for the purposes of applying other requirements in NZ IFRS. So, for example, interest expense on a lease liability applying NZ IFRS 16 leases, and interest expense on a contract liability with a significant financing component, as specified by NZ IFRS 15, would both be classified in the investing category. In contrast, NZ IFRS 2 share-based payment does not require an entity to disaggregate the income and expenses arising from changes in the carrying amount of a share-based payment liability, and therefore any interest expense component would not be classified in the financing category. In short, NZ IFRS 18 does not introduce additional disaggregation requirements beyond those required by other standards for the purposes of classifying interest income and expenses separately from other types of income and expenses. NZ IFRS 18 contains some specific requirements that apply to particular types of complex financing arrangements, as well as specific requirements relating to the classification of gains and losses on derivatives and designated hedging instruments. If you have such complex financing arrangements, we encourage you to read the relevant sections of the standard carefully. Nimish will touch upon these later on in this presentation. So this slide shows you an example of what the financing category in the statement of profit or loss looks like. So as I've noted a couple of times, the specific line items presented will not necessarily be the same across all entities. Now, the two remaining categories relate to income taxes and discontinued operations. Entities must classify tax expense or tax income in the income tax category, as well as any related foreign exchange differences. Nimish will explain the specific classification requirements relating to foreign exchange gains or losses later on in this presentation. In the discontinued operations category, entities must classify income and expenses from discontinued operations as required by NZ IFRS 5, non-current assets held for sale and discontinued operations. So as a recap, I'm showing you the complete example. As I mentioned before, line items for each entity will likely differ, and additional subtotals can be presented to provide a useful structured summary of income and expenses, as long as income and expenses are still classified in the appropriate categories. So for example, there are no required subtotals attached to the income taxes and discontinued operations categories. However, entities generally present the subtotals profit or loss before income tax and profit or loss from continuing operations, as you can see here. We will go into more detail on what we mean by a useful structured summary and the related aggregation and disaggregation principles in NZ IFRS 18 at our next webinar. So that's it for the general classification requirements. We'll now take a closer look at the concept of a specified main business activity, of which there are two: investing in assets and providing financing to customers. Now, as I mentioned previously in this presentation, some income and expenses relating to these main business activities would end up classified in the investing or financing category when applying the general classification requirements covered in the last few slides. Therefore, an entity would be prevented from presenting key measures of its operating performance in the operating category. For this reason, NZ IFRS 18 requires entities with one or both of these main business activities to classify certain income and expenses in the operating category. Some examples of entities that engage in these main business activities are shown on the slide here. You can have none, one, or both of these specified main business activities, and it is important to know where you are so that the principles of the new standard can be easily understood and applied when preparing your statement of profit or loss. To allow stakeholders to understand the structure of an entity's statement of profit or loss, NZ IFRS 18 requires both Tier 1 and Tier 2 entities that engage in a specified main business activity to disclose that fact in the notes. NZ IFRS 18 requires entities to assess whether they have a specified main business activity in order to appropriately classify income and expenses into the operating, investing, and financing categories. First of all, it is important to note that whether investing in assets or providing financing to customers is a main business activity is a matter of fact and not merely an assertion made by management for the purposes of preparing the financial statements. Determining whether there is a specified main business activity therefore requires assessment of the available evidence relating to the entity's particular facts and circumstances. The assessment is performed for the reporting entity as a whole, and therefore the assessment at the group level could differ from the assessment at an individual subsidiary level. This might require reclassification of income and expenses within the statement of profit or loss upon consolidation. For example, a subsidiary might invest in assets as a main business activity, even though the group does not. An entity is likely to have a specified main business activity if a particular type of subtotal is used as an important indicator of operating performance. For example, net interest income, insurance service result, or net rental income. Such subtotals are similar to gross profit and include income and expenses that would typically be classified in the investing or financing categories if the entity were not engaged in the specified main business activity. Now, if this type of subtotal is used to explain operating performance to stakeholders, or for internal monitoring or assessment of operating performance, this is evidence that the subtotal is an important indicator of operating performance. For example, if an entity provides financing to customers as a main business activity, it generally communicates or monitors net interest income as a measure of its operating performance. Segment information may also provide evidence of a main business activity. If a reportable segment comprises a single business activity, this indicates that the performance of the reportable segment is an important indicator of operating performance, which means that the business activity of the reportable segment is a main business activity. If an operating segment comprises a single business activity, this indicates that the business activity might be a main business activity if the performance of the operating segment is an important indicator of operating performance. An entity need not consider whether it invests in cash and cash equivalents as a main business activity, and this is because the related income and expenses are classified in the investing category, with some exceptions that Nimish will discuss a bit later. Also, an entity need not consider whether it invests in equity accounted investments in associates and joint ventures as a main business activity. This is because income and expenses relating to these investments will always be classified in the investing category to ensure that the entity's reporting aligns with the way users of financial statements prefer to analyze these types of investments. Other than these two types of assets, all other types of assets are considered on an individual basis or as a group based on shared characteristics when assessing whether the entity invests in a particular asset or group of assets as a main business activity, as long as the assets are investments in associates, joint ventures, and non-consolidated subsidiaries not accounted for using the equity method, or generate a return individually and largely independently of the entity's other resources. If there is a change in facts and circumstances, this may change the outcome of the entity's assessment. So for example, the entity might start a new line of business involving investing in assets or providing financing to customers. Such a change would, however, not require reclassification of income and expenses before the date of the change. However, to avoid disrupting users' trend analysis of operating profit, the entity would be required to disclose that the assessment has changed and information about the timing and effects of the change, unless it's impracticable to do so. In the May edition of our monthly NZ IFRS 18 newsletter, we put a spotlight on specified main business activities and the key considerations when making the assessment. We encourage you to use this newsletter as a reference when thinking about whether you have a specified main business activity. And with that, I'll now hand over to Nimish to take us through the classification requirements when there is a specified main business activity.
Thank you very much, Carly. And I just want to pause for a second. I appreciate a lot of the information Carly's just gone through is quite a lot to take in. And this is a fundamental change to the way that your statement and profit or loss will be prepared going forward. So I would encourage everyone to familiarize yourself with NZ IFRS 18 and digest it. Take a while to think about how it would apply to your entity and your financial statements. This is very much a marathon and not a sprint. So it will take some time to get used to these concepts and to think about how it actually applies. So take that time where you can. This is not applicable until 1 January 2027 and periods beginning on that date going forward. So there is a bit of time to work through this and consider how it actually applies in practice. With that, and as Carly mentioned, I want to just talk through some of the more specific technical areas around what happens when you do have a specified main business activity. So this is not applicable to every single entity out there. It's only applicable if you do identify that you have a main business activity of investing in assets. And to Carly's earlier point, in these situations, the operating category may not accurately reflect the operations of your entity if you follow the general principles under NZ IFRS 18. So NZ IFRS 18 requires these particular types of entities to put more into the operating category to make it have a complete and fair representation of the operating activities. So if you do invest in assets as a main business activity, where you classify the income and expenses of particular types of assets depends upon that main business activity. So investments in associates, JVs, and unconsolidated subsidiaries would go into investing if they are equity accounted for under NZ IAS 28. But they may also be in operating if you do not equity account for them and you have a main business activity to invest in those particular types of assets. Similarly, with cash and cash equivalents, if you do have a main business activity of investing in financial assets to generate individual or largely independent returns, that will go in operating category. Otherwise, it will default to the general principle of going into investing. And likewise, if you have a main business activity of investing in other types of assets that generate individual or largely independent returns, then that will be part of your operating category. So again, just to be clear, these principles override the general principles if you have a specified main business activity of investing in assets. And on the next slide, we present what your statement of profit and loss may look like if you do have a specified main business activity of investing in assets. This would generally be applicable to a lot of registered insurers out there, and you'll see more income and expenses are recognised in the operating category, and as a result of that, you may want to include additional subtotals within the operating category itself to help users understand what the net results of some of the gross income and expenses may be. It doesn't mean you don't have an investing category. You may still end up with some income and expenses in your investing category itself. It just means certain income and expenses would be moving into the operating category if you had followed the general NZ IFRS 18 principles. And similarly, on the next slide, there are also differences if you have a main business activity of providing financing to customers. So this would typically include your banks and your car dealerships and any retailers that do hire purchase sales. Where you do provide financing to customers as a main business activity, again, certain cash flows that may have been in your financing category will be moving into your operating category. So this table talks about the different types of liabilities and income and expenses that may result on those types of assets and liabilities and where they are classified in the statement of profit and loss. So typically, cash and cash equivalents would be in operating if you do have a specified main business activity of providing financing to customers. But where they do not relate to providing financing to customers, as Carly explained earlier, there is an accounting policy choice to recognise this in either operating or investing. And similarly, liabilities that don't arise from only raising of finance can also be either chosen to be classified into operating or financing categories. Now, this is very nuanced in terms of a banking entity's operations, but this practical expedient of putting everything into operating is done to make the resulting statement of profit and loss easier to compile. There will be quite a lot of difficulties in terms of entities trying to figure out which bits of their cash relate to just financing and which bits of their cash relate to financing plus other things. So if you do have a main business activity of providing financing, there is a practical expedient and accounting policy choice to put all the income and expenses resulting from those transactions into operating. It's worth noting that that accounting policy choice in the first row and the second row must be consistent. It's an all or nothing situation. Either all of the income and expenses from those liabilities and assets go into operating, or they go into investing and financing. So there's no picking and choosing between certain transactions. It's a consistent accounting policy choice across the different types of assets and liabilities. On the next slide, we present what a statement of profit and loss may look like for an entity that does provide financing to customers and investing in assets as a specified main business activity. So again, you'll see quite a lot more in the operating category itself, with potential additional subtotals to help explain different streams of revenue and expenses. But again, you'll also notice that you can still have investing and financing income and expenses when you do still have these specified main business activities. It just won't be as great as it would have been applying the general principles. The other thing to very quickly mention is if you do have a specified main business activity of providing financing to customers, and you, as part of your accounting policies, choose to recognize the income and expenses on cash and cash equivalents and transactions that only involve the raising of finance in the operating category, you cannot present the subtotal of profit and loss before financing and income taxes. That's simply because you are deliberately putting some of your financing income and expenses into the operating category. So a subtotal that says profit or loss before financing would become meaningless. So if you do elect to put it in operating, you cannot present this as subtotal of profit before financing and income taxes. Again, I appreciate it's very, very nuanced and won't apply to every single entity out there. But if you do identify having a specified main business activity, please refer back to these slides, familiarize yourself with these particular requirements of NZ IFRS 18, because they are different to the general principles, and they're much more focused in terms of creating a complete picture of operating for those specific types of entities. So on the next slide, I wanted to talk about foreign exchange differences. So this applies to every single entity out there. This is not dependent on what your main business activity is. But there's been a lot of questions to the IASB around where do FX differences get recognised. And the principles of NZ IFRS 18 is to recognise the foreign exchange difference based on where the item of income and expenses generated that difference. So if it's a FX difference generated on a revenue transaction, if that revenue income is recognised in the operating category, the foreign exchange impact will also be recognised in the operating category. This is to allow for a complete picture of those transactions rather than fragmenting them across different categories and causing a lot of noise and confusion in your statement of profit and loss. And there is a practical expedient that if this is going to result in a lot of undue cost or effort, then there is a practical expedient to recognise this all FX gains and losses in the operating category. So this may very well mean that within the operating, investing and financing categories, you may have foreign exchange differences 3 times across each of the categories, and that's completely okay if that's how the transactions that you've occurred in the year give rise to those foreign exchange differences. The next slide talks about another common type of transaction, which are derivatives. A lot of our tier 1 entities do use derivatives in many different ways, and the accounting for the gains and losses on derivatives is also one where we've received a number of questions, given they're very common but used for lots of different purposes. And the classification here very much depends upon whether the instrument itself is designated as a hedging instrument under the requirements of NZ IFRS 9, and if not, if it's not a hedging instrument, if it's still being used to manage an identified risk. So where there is a hedging instrument, it will be used, and the income expenses on the derivative should be matched to where the underlying risk it's trying to manage is. So that may be across all types of categories, depending upon what risk it's being used to manage. Otherwise, it should be in the operating category. Now, there is a particular expedient in NZ IFRS 18 around the grossing up of gains and losses. So, for example, if you are using a derivative that is being used to manage a net foreign exchange risk on a revenue transaction as well as interest expenses on a financing transaction, then in order to present that derivatives gains and losses across both those hedges would require you to gross up the gain or loss across the operating and financing category, because the underlying transactions across revenue and your debt would be across operating and financing. So in those situations, NZ IFRS 18 simplifies the entire process and says, don't incur the cost of trying to gross up transactions, just put it all in operating. Avoid the nuances of trying to inflate gross gains and losses. Effectively, the net gain and loss should just go into the operating category if you are thinking or required to gross up those gains and losses to get an accurate picture of how it reflects the underlying risk management. So the requirements are slightly different for when you manage an identified risk or when you don't classify them as a hedging instrument or use it to manage an identified risk. And those are set out in the slides, and that's a little bit more simpler in terms of recognizing them in your statement of profit or loss. The next slide is just the completeness check in terms of what happens with other financial instruments that are not derivatives that are also being used to potentially manage an identified risk or designated as hedge accounting. And these principles are very much the same as if it was a derivative. If you do use it to manage an identified risk, match it to where that identified risk, income and expenses, are being recognized. Otherwise, put it in operating if it would involve grossing up the gains and losses. And if it's just a financial instrument that is not a hedging instrument and not used to manage an identified risk, then it will just follow the general principles, as Carly explained earlier, and subject to the modifications created if you have a specified main business activity. So again, I appreciate this is quite complicated things, but if you do regularly enter into derivatives, and you know if you would, please be familiar with these types of or these requirements in NZ IFRS 18, because they are a little bit more nuanced and may take a little bit more thinking than general operating revenue and expenses. The next slide talks about changes to NZ IAS 7, the statement of cash flows. So everything we've spoken about previously is in relation to the statement of profit and loss and how you categorize income and expenses. NZ IFRS 18 does have some consequential impacts on NZ IAS 7 and how and where you recognize things in your statement of cash flows. So the first main change is the reconciliation used under the indirect method. So now that the statement of profit and loss will include a specific subtotal around operating profit or loss, NZ IAS 7 will now require that particular subtotal to be used as the reconciliation point to your operating cash flows or your net operating cash flows. So that's just to eliminate the noise and make it simpler, given the statement of profit and loss now will directly report a operating profit or loss. The noise of investing and financing, income and expenses are already presented on the statement of profit and loss, so don't need to be duplicated in the cash flows reconciliation. The next changes around dividends and interest in the statement of cash flows. So previously under NZ IAS 7, there has been presentation alternatives. The entity could elect to put these particular types of cash inflows and cash outflows into either the operating, investing, or financing activities based upon their own judgment and how they were using those particular cash flows as part of their operations. This created a lot of inconsistency across very, very common types of transactions. So on the next slide, we just outline how these impacts have been changed. NZ IFRS 18 effectively eliminates the ability to choose where you put interest received, interest paid, dividends received, and dividends paid. They are now required and based off whether you have a specified main business activity or not. But all interest received and dividend received should be in your investing activities within the statement of cash flows, and interest paid and dividend paid should be in your financing activities. If you do have a specified main business activity, then your interest received, your interest paid, and your dividends received should follow where you put the relevant income and expense in the statement of profit and loss. But regardless of that, dividends paid will always be financing activities in your statement of cash flows, given it is the cost of your capital. So that's a whirlwind tour through NZ IAS 7 changes, and we'll pass you back to Carly now just to provide some key considerations and other helpful resources.
Thanks, Nimish. So this brings us to the end of our deep dive into the NZ IFRS 18 requirements for new categories and subtotals. So as you will have seen throughout this presentation, and as Nimish said earlier, there is a lot to think about when it comes to these new requirements. And so we do encourage you to start thinking about them now, as you will most likely need quite a bit of time to really understand how it will impact your entity and to work out what you need to do in order to follow the requirements. Now, this slide just sets out some of the key considerations for preparers that we shared in our April NZ IFRS 18 monthly newsletter. And this is based on the panel discussion held during the ISB Vice Chair's visit to New Zealand last year. What I want to just emphasize here especially is that NZ IFRS 18 requires entities to restate comparative information when it is first applied. For example, an entity with the 31st of December reporting date that applies the standard from the mandatory date of 1st of January 2027 will need to restate its financial results for the year ending 31st of December 2026. So we do suggest you start thinking about the relevant data you'll need to capture from 1st of January 2026. Before we close off this presentation, we want to make you aware of other NZ IFRS 18 related developments. So the New Zealand Accounting Standards Board is expected to approve the amending standard RDR concessions NZ IFRS 18 at their meeting on 11th of June. The consultation on this amending standard has recently closed, and we expect to issue the amending standard at the end of June if approval is granted. The amending standard provides disclosure concessions for Tier 2 entities on some of the new disclosure requirements introduced by NZ IFRS 18. There are no disclosure concessions relating to the requirements that we've presented, that we have discussed in this presentation. But the amending standard provides concessions on all the management-defined performance measures, primarily for cost-benefit reasons. Also, a similar concession has been granted on the disclosure requirement relating to management-defined performance measures in the interim financial statements. We will discuss the requirements relating to management-defined performance measures at our third deep dive webinar in October. The amending standard also provides a disclosure concession on the requirements to disclose information about certain operating expenses by nature when using the functional classification in the statement of profit or loss. And we'll discuss this a little bit more at our deep dive webinar in August. Please note that existing disclosure concessions in NZ IAS 1 have been carried over into NZ IFRS 18, where the related disclosure requirement is unchanged. And there is still one open consultation relating to NZ IFRS 18. In this consultation, we have proposed to amend the following standards: FRS 42, prospective financial statements; FRS 43, summary financial statements; and FRS 44, New Zealand additional disclosures. So these proposed amendments to FRS 42 and 43 aim to ensure that the presentation requirements for prospective and summary financial statements are consistent, where appropriate, with the requirements for the presentation of historical financial statements under NZ IFRS 18. And the proposed amendment to FRS 44 aims to ensure consistency with the requirements in NZ IFRS 18 and changes to NZ IAS 7, Statement of Cash Flows. Please provide us with your feedback through the link on the slide or visit our open consultation page on our website. The consultation closes on 31st of July. And lastly, we just want to remind you of all the educational material available on our dedicated NZ IFRS 18 page on our website. And finally, if you've not yet done so, we encourage you to sign up to our NZ IFRS 18 on the 18th alert series, where we share key points, information, and guidance to help you understand the new requirements. You can find past editions on our NZ IFRS 18 webpage. Now I'll hand over to Nimish to close. Thank you very much.
So thank you all for attending. As mentioned earlier, I know this is a significant new standard. It will take some time to think through for each individual entity. Please do reach out to the Itsabi if you have questions, and if you want to have a conversation with us about these principles. We may not be able to give you direct accounting advice or give you a conclusion, but we can certainly help point you in directions and matters to think about as you go through applying your own judgment. We do have a couple of questions in the chat around particular things. So one question is, how would dividend income on investments required for operating activities to be carried out be categorized? For example, dividends on Fonterra's shares held by a farming operation. And I think this very much depends upon your judgment and your purpose of holding those particular assets and how independently that dividend income is being generated. If that dividend income is largely independent and individual from your normal operations, then it should be in your investing category. If it is part and parcel and intertwined into your operations, then it would be in your operating category, but it would very much be a judgment call based on the facts and situations of your particular entity. And the second question we've got is, when part of a group, intercompany transactions part of operating? And I think, again, that very much will depend upon what the underlying transaction is. So some intergroup entities may just exist to provide financing or hold a bond or a debt to another entity within the group. If that is the case and the purpose of that entity is just to do particular financing, that income and expense may very well be in the financing category for that individual entity. But if its operations is to transact with other entities within the group, that income and expense transactions may be in the operating category. So thank you all very much. It's been useful to talk this through with you. I hope you found it all useful. Please do sign up to the next deep dive webinar in August, where we will talk about another dimension of NZ IFRS 18. There is a lot in the standard, so please familiarise yourself with our resources and reach out to us if there's any particular questions. Thank you all very much and have a good rest of your day.